Squarespace stock went public today, the ticker SQSP via direct listing. I, for one, like direct listings. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. The reason why I like direct listings is it creates greater opportunities for retail investors in that you don't have sort of the skewed or rigged process of the traditional IPO where the thing pops or you're not able to get it at necessarily a cheap valuation. Here it is. Usually direct listings are the insiders are selling directly to you, the potential shareholders are looking to buy shares. So I like direct listings because it can create value opportunities, and there have been several direct listings in the past. Palantir is one that a lot of people benefited from. So I see direct listings and my ears tingle. So let's keep going. So direct listing with Squarespace, SQSP. So that's the first part, and I see that the valuation's also down quite a bit. So I'm starting to wonder if this is a potential bargain. You know, they talk about how the reference price was going to be about $50 a share. It closed at around $44 a share. They did a private valuation, a private fundraise earlier this year at a $10 billion valuation. Today it closed below a $6 billion valuation. So you're looking at a 40% haircut just from where it was a few months ago. So that does get me a bit interested. You know, just for some context, you know, I from my own personal background working on Wall Street, particularly my focus with investment banking, when it's traditional in investment banking that you use comps to sort of say, well, wait a second, this is where it previously traded, therefore this is a bargain. So you need to recognize that it's always possible that the initial data point is skewed. So that we're going to want to dig deeper, but at first glance, you know, this is showing, hey, a 40% discount to its prior fundraise. So it creates a question of, was that prior fundraise overly expensive? Was it rational? You know, and just keep in mind, it was just a few months ago, 40% discount. And the discount, I'd say with Squarespace is getting even bigger. Let's see why in just a second. Where if you look at the price to 2020 gross profit, I'm not even looking out forward, I'm just looking at their gross profit. It's important to use gross profit, by the way, because when you're looking at different types of business models, some have much higher gross margins than others. So for example, Shopify, which is one of the behemoths in the platform space enabling e-commerce for individual businesses, it has a much lower gross margin just based on their business structure, whereas Squarespace, their gross margin is way higher. You're looking at like 80% gross margin. So the way to think about it is how to value this business relative to its gross profit. So revenue less cost of sales in terms of thinking about it. And as I look at this, I'm thinking Shopify trades at 90 times price to 2020 gross profit, whereas Squarespace trades at 11 times. So now, you know, I'm looking at this and I'm thinking, wow, this really does, you know, first of all, you got the discount from the same day, where reference price was 50, then it closed at 44. You know, the prior fundraise at 10 billion, now it's below 6 billion. And then you look at Shopify, which is the chief player in this space. It's an incredible company. It's the unrivaled play, arguably, in enabling e-commerce for individual merchants. And I'm thinking, wow, this has a 90% valuation discount to that. Is it warranted? So let's sort of understand that, and let's also understand their business model a little bit better. And so, you know, when we understand Squarespace, when we're looking at it, it's everything you need to grow online. It's enabling e-commerce for small and medium-sized businesses, and it's what you'd expect. It's the necessary tools, whether or not it's setting up the website or domain, getting you connected to a social media platform to make it easier for you to advertise, setting up your professional work email, basic commerce tools, you know, making it possible to sell physical goods or have subscriptions, you know, scheduling if it's like a service type of thing, or member areas, or marketing. These are the critical tools for any small business that or medium-sized business that's looking to grow online. You know, you need to be able to tackle each of these things, and this is part of their appeal of Squarespace, is having this beautiful presence and ideally having this seamless experience. And with their marketing, you know, managing, how do you manage your email marketing, your search engine optimization, your analytics of the users that come into it? So how does all of this sort of translate into a business model? And as you look at it, you have about 3.7 million unique subscriptions. You know, that means businesses that are subscribing to Squarespace, all in about 621 million in revenue in 2020. 28% growth. That is a little bit of a red flag for me, just because I know e-commerce was growing crazy fast in 2020, which is not unexpected. But maybe that's because they're overly, subscription-oriented business model. And, look, their subscription-based revenue is 94%. So that does make it a lot stickier than, let's say, a business that's tied to, whatever business processing or the merchandise that goes through their platform. Like Shopify is heavily tied to the merchandise that goes through their platform. They do have a strong subscription element, but it's nowhere near the 94% that you see here. And also, I like to see here 150 million in unlevered free cash flow. I mean, this business has been self-sustaining. I mean, this business was bootstrapped for several years where they didn't even need to raise outside capital, and to see that they're generating meaningful cash flow is certainly interesting. It's fundamentally a subscription business, subscriptions for businesses, and then you have a few percentage of the business, effectively revenue share agreements tied to the payment processors, that effectively they direct business to. Think of a Stripe or a Square. And so then the big question now is, okay, so we are talking about a 90% discount, from Shopify to Squarespace. The question is it warranted? And, could this mean a dramatic bargain? And the unfortunate reality is this is sort of where the bargain basement 90% discount thesis sort of starts to fall apart. I mean, the wheels come off the bus. It's not even close as you look at it. Where Shopify had 120 billion plus in merchandise value that went across their platform versus 4 billion for Squarespace. So well over, a 90%, difference in terms of size, just so much smaller. That said, their gross profit margins were, I would say Shopify's only 3x bigger. Now 3x is meaningful, especially when you see that they're growing so much faster. They're growing 86% versus only 28% for Squarespace. And why is this so important? The reason why this is so important is that Shopify can then take those gross profits and reinvest them into adding more and more functionality. If you're growing at 86% and your competitor is only growing, 20%, you have an advantage, because that means you're going to be able to funnel more and more resources to build out your product, enhance your value proposition. So I'm looking at this and I'm saying, this is going to be a tricky spot for Squarespace. Even though it has this dramatic discount, it does sort of suggest that they certainly aren't competing, nearly as well as Shopify in terms of growing, grabbing land, grabbing market share, and just grabbing a bigger slice of the pie of the ecosystem. So I look at this and it is a big red flag. And this does sort of say, oh, okay, you know what, that whole 90% off, that's not going to fit. Even if you the initial take is like, yeah, this is a bargain. The reality is Shopify is just a beast relative to all these other players. Squarespace, I did a previous video on BigCommerce, and I think a lot of people are sort of have the war, the shock from trying to get another Shopify by buying BigCommerce. And I called out with the BigCommerce, IPO, and you can look it up, where I was like, man, this thing's crazy price. It's going to hurt shareholders significantly. It's down about 50% since then. So I mean, I think there's a lot of that, like, I don't want to get burned out again like I did in BigCommerce. And a lot of investors, I think, are saying, instead of investing in the almost Shopify stock, a lot of people are saying, hey, why not just own Shopify? And that's the question that a lot of people keep confronting. My challenge with Shopify is the valuation. But let's keep going in terms of maybe Squarespace, the valuation could still make it a compelling risk reward, even if it's not unrivaled. So clearly not unrivaled when you think about how Shopify is just eating their lunch, growing so much faster, just tapping into much greater volume of business going across their platform. But could it be cheap enough? Could it still be a compelling stock? And, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no hype, mission focused, channel trying to find potential multi-baggers. So if you enjoy learning about these types of stocks, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking for these types of stocks, each month, the first week of the month, I call out my full portfolio. And then during the month, I also call out one new potential multi-bagger. So that's for the patient investors that are looking for the types of stocks that could potentially go up 200, 300, 400% over time, maybe even thousands of percent over time. And each month I'm calling out one new idea for those investors that are looking to build out their portfolio, maybe add a few percent each month to a new potential idea. That's at unrivaledinvesting.com. Let's get back into whether or not Squarespace is actually a really cheap and compelling stock. And so as we look at it, as I look at this valuation, I'm seeing, it's around $44 a share. It's just under $6 billion market cap. It only grew 24%, in 2019. It only grew 28% in 2020. This is, I would argue, is losing share. Yes, they're helping to expand the pie, but you're just not taking share nearly as fast as someone like Shopify that's just gobbling it up and arguably reinvesting into their business model so that way they can continue to gobble up and continue to add value in ways that'll make it increasingly difficult for their competitors to compete, just because they're going to enrich their ecosystem further and further over time. And so, that said, given the fact that Squarespace does have around 80% gross margin, I do think longer term their optimized margins could be 30 to 40%, slap on a tax rate, and based on their 2021, hypothetical revenue of, let's say, 750 million to 800 million in revenue, this is a hypothetical figure. They're effectively trading at a mid 20s to low 30s type of optimize multiple. This assumes that they would optimize their business right now for profits. They're not looking to do that. They're trying to grow quickly, but clearly not fast enough. This is just a framework, by the way. Of course, stock prices go way higher, way lower. So then what's the subsequent growth in the ensuing four years after 2021? Because I'm trying to take a 5-year time frame. I'm a long-term investor with everything I'm looking at. And so, I do pencil out a range of low teens to about 20% annualized growth. Part of that's just from the fact that they were only growing at 20%, 24% in 2019. So, over the ensuing 4 years, maybe it annualizes out to a high teens rate. And then what's the end multiple that you want to assume for that? So I'm doing 15 to 25 times, from a low to high range. And that effectively gets you to a downside of about 30%, upside to over, 100, about over 100%, about 110% upside. So it's not bad. Don't get me wrong. It's not terrible. When I called out BigCommerce, I was just like, wow, this valuation makes no sense. This is going to lose shareholders a lot of money. And it probably did, because the stock's down about 50% since then. So it's not great. I certainly think you could find better risk reward elsewhere. And for example, I have called out how I personally do own Alibaba stock, and that's a perfect example of something that I do think is a much better risk reward, where, for example, Alibaba's cloud business alone could potentially be worth all of their current market cap. And that's a whole separate video if you're interested. Also, for Unrivaled Investing Journey subscribers, where each month I call out a new idea, for May, I did call out a liquidation play, so a company that trades below liquidation value that has, I'd argue, 2 to 3x upside over the next 5 years. So that is the type of investment that I'm looking for, where I'm trying to get my downside covered, and then the upside. Hey, if it works out, then you get this huge upside return, whereas my downside is protected. Where something like this, it's like, not that super compelling. And hopefully this video, in terms of talking about Squarespace, looking at their business model relative to Shopify, how fast they're growing, their size, hopefully this has been helpful for you. If so, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.